Hello and welcome to Fibonacci Trading Masterclass. In this first video, the module How to Use Fibonacci Tools gets kicked off. We'll talk about understanding Fib or Fibonacci retracements and levels. So a Fibonacci retracement is based upon a mathematical equation that Leonardo Fibonacci did in fact discover in the 1200s. Now, basically what it states is there is a formula that works out like this. So what you're seeing is the Fibonacci sequence. And so on. So the pattern is basically two numbers added together make a third number. Then the second and the third number add together make a fourth number. The third and fourth number together added make a fifth number, and so on. The ratios are mathematical equations that appear time and time again in history, as far as art, as well as nature and agriculture and a whole host of other things. So sometimes when you see like a mountain range, you'll see that mountains grow in Fibonacci ratios as far as height proportion, or rivers may bend a certain percentage. So the idea is it's a very natural way of things to progress. So with that being said, the markets, at least in theory, follow this because so does everything else in nature. Now, there is a golden ratio, 61.8%, or as it's shown on the Fib retracement. So what this means is, in a move, like if the market goes higher, if it pulls back 61.8% of the original move, supposedly that's the golden ratio. There's a lot of interest there. Now, what's interesting about Fibonacci is whether it works or not, the answer to that will definitely be wildly different from one trader to the next. But the one thing that you can take away from Fibonacci is that enough people believe in it that it's somewhat of a self-fulfilling prophecy. So at the end of the day, it really doesn't matter if there's some kind of mystic mathematical power or not. Enough people believe that it exists that it does tend to kind of come true. Unfortunately, there's a lot of bad technicians out there who will bend the lines to kind of fit whatever mold they want. One of the main parts of this course is to add layers of confirmation upon Fibonacci, so you're not just trading a Fib. So, for example, if a market pulls back 61.8%, you're not just buying because it pulled back 61.8%. There are other Fibonacci levels, as mentioned previously, and we'll take a look at them. So, to draw a tool, a Fibonacci tool, on this side here, there is the Pitchfork or Gannon Fibonacci tools, and Pitchfork is normally the one that is default. What you're looking for is a Fib retracement, and you can go from where a move started to where it stopped. So I'm basically targeting this, right? Now you'll notice that there are quite a few levels here. There's 23.6, 38.2, 50, 61.8, 78.6, and then 1, which is 100%. Now notice how there are reactions to each of these levels, using this as the swing low and the swing high, because you are trying to capture the bulk of the move. You are trying to make sense of where we are in relation to the most recent move. So for example, had you been over here and you saw a bounce, you would see we're at the 23.6 Fibonacci retracement level and sold. Had you taken the trade from here, you'd see that we pulled back to 23.6 and you would have sold. From here, pretty much the same thing. So you're seeing it time and time again. So that does tend to lead a little bit of credence to it. Now, the first thing that I would do, just to kind of clean things up, is draw out this tool and then go up to the Settings tab. And we are going to extend lines to the left, or excuse me, to the right, so that it goes over here. And we're going to get rid of a lot of the less used Fibonacci levels. So there are really only 3 major levels that most traders will use. So get rid of 4.236, 2.618, 3.618, 1.618, 78.6, 23.6. So at this point, you only have a handful of lines. The higher numbers like the 1.618 are part of what are known as Fibonacci extensions. We do talk about that in a couple of videos. So I'll get back to those. But for the most part, these are the 3 main levels that traders pay attention to. Yes, the 78.6 is technically a Fibonacci retracement level, but the problem with using every single Fibonacci retracement level is that you run into issues of there's a line every, little move that's going to be in your way. So it's almost impossible to use for any significant amount of time. So what you're looking for, again, are swing highs and swing lows. Swing high, swing low, swung back to the high. So let's see if that lines up quite nicely, and it does. At the 38.2%, we broke down. What about to here? Well, no, it doesn't. And that's kind of where this gets to be a art form that you need to have several layers upon. So for example, had you just sold right here, like I said, at the 61.8, you would have taken a 500 pip loss initially, because this is dollar-yen weekly. However, to put things in perspective, selling here at about 124, 125, you could have dropped, 900 pips. So it definitely has its merits. Now, we will add things to this that would have told you, maybe that isn't where you want to be involved in. So let's take a look at support and resistance and kind of put this, and I'll bring up a fresh, just kind of random chart. Euro dollar. Okay, so euro dollar, let's start drawing support and resistance lines. So we can go over here on the trend line, go to horizontal line, and I'm just going to plot these as I see them on the chart real quick. Areas where the markets have clearly reacted, right? So what happens is, and this is a little bit of a preview on what we'll be talking about later in the course. So let's draw, for example, from this move down to here. Well, when you start to clean this up a little bit, when you start to look at Fib and support and resistance, you'll notice the two are highly levered towards each other. Notice how there is a support and resistance area right here, and we also have the 61.8. And that's what is known as confluence. It shows an area where people are going to be looking at both just horizontal support and resistance, maybe a big figure like a 1.40 or whatever, previous noise, and the 61.8. Well, now you're starting to begin a little bit of system building. You're not just taking blindly on the Fibonacci retracement. Because unfortunately, that is a really, really good way to lose money by simply just jumping in blindly. And that's going to be true with any indicator or system or whatever. So looking in the other direction, I'll get rid of some of these distractions here. So I see swing low before we took off to here. And notice how the 38.2 is right there. And okay, so why does this price matter? Well, you can see that markets peeled back from there multiple times and found support right here. So when we came back, that's an area that the market was interested in both directions, support and resistance, and has the 38.2, which is one of the most commonly followed Fibonacci ratios. It's not the golden ratio like I mentioned earlier, but that's fine. It doesn't have to be. There are a couple caveats on each ratio that you should be aware of. Typically, not always, this is just basic normal behavior. When a market pulls back to 38.2 and that's as far as it goes, it typically means there's plenty of momentum to the upside. And you can see we went all the way to 160. This is euro-dollar weekly chart. These are big moves. 50 is average, 61.8, a little bit more average. 50 actually technically is not a Fibonacci retracement number, but it's included in the tool because 50% retracements have been used so long on Wall Street and places like that traders just have included them in the Fibonacci toolkit. It really for no other reason than that. You know, here's another Fibonacci retracement possibility. You can see that we had pulled back here. Again, this is a weekly chart, so that's a pretty significant pullback. Rallied all the way there. 61.8. You can see that there is support there from previous trading and resistance. So it all ties together quite nicely. However, again, having said that, being at the level, even though it's the golden mean, is not reason enough to take the trade by itself. And that's what this course is about. It's taking this basic tool that may or may not only be self-fulfilling, but you know, there's got to be some mathematical sense to it, considering nature tends to repeat it. But self-fulfilling is irrelevant. If you're doing what the rest of the market's doing, you're making money. So keep that in mind. But we're going to add layers of protection on top of it and analysis to really kick things into high gears. In the next video, we'll talk about looking at strategies for trading Fibonacci retracement, finding the levels, showing how to draw it a little bit more in depth on the TradingView platform and in various markets.